Value investing, to make an analogy, is when your favorite pair of socks go on sale at 50% the usual price. You know them, you like them, you've been buying them repeatedly, and then, they're just cheaper. So that's value investing in essence.
Thanks for listening to IBKR's Sense of Security. As always, there's more content at ibkrpodcast.com. And if you're interested in learning more about interactive brokers, visit ibkr.com. We offer more trading education content such as webinars, market commentary, market-related courses, and quant-related articles at ibkrcampus.com.
Welcome back to the Sense of Securities podcast. I'm Cassidy Clement, Senior Manager of SEO and Content at Interactive Brokers. Today I'm your host for our podcast, and our guest is Stefano Grasso, the Senior Portfolio Manager for Enhanced Value Fund. Since both growth and value can be positive for investor portfolios, which strategy is the right way to go? And are there more risks with one or the other? All that and more is going to be discussed today as we explore value versus growth investing. Welcome to the program, Stefano.
Hello. Hi, Cassidy. Thank you for having me.
Of course. So you've been on some of our other IBKR podcasts, some of them talking about different investing sectors and opportunities and so on and so forth. What is your background in the industry for our listeners?
I believe I'm I have a different background from many portfolio managers. I haven't done this for the whole of my career. I started my career in consulting with McKinsey. With them, I studied also. I earned my MBA at Columbia Business School in New York in 2009. I then moved to Eni oil and gas company. I was in their trading unit in London initially, and then I moved to Singapore as head of the trading operation for the Asia Pacific region. So I come with this sort of consulting and trading background, and I started then in 2020. I decided to join an asset management company, launch Enhanced Value Fund, which is the fund that I now manage. But specifically talking about investments, let's say in parallel to this working experience, I started managing my family portfolio in 2000, right after the dot-com crisis. I inherited the portfolio and I managed it via ETF. That was what I was doing before like going to the business school. At Columbia, I happened to meet with Warren Buffett, and I was kind of enlightened by the value investing approach and philosophy. And since then, I started moving the portfolio from just ETF to single stocks. Initially, the ones that Berkshire Hathaway, the company Warren Buffett was investing in, and then venturing into what I thought was my kind of area of competence, circle of competence. And since those years, I've been investing in the stock market, and then with my work in the commodity market, and here we are.
Well, that's great. So, seems like you have great exposure to the exact topic today from both business and personal investing. So to kick it right off, what really is the difference between the value investing and growth investing? So,
as I mentioned before, I discovered value investing at Columbia Business School. There is a program that I did that was called the Value Investing Program. Actually, I took the course with Professor Bruce Greenwood. And, everything dates back to Benjamin Graham. He was the teacher of Warren Buffett. And his definition is of investing, and what then became value investing, is deriving the intrinsic value of a common stock independent of its market price. So, currently we have, technical analysis, the momentum traders, and a lot of information for what is called traders is driven by the actual price movement. So it's a loop whereby the actual result, you're trying to predict the actual results by studying the previous inputs in terms of stock price and funds flows and things like that. Benjamin Graham was having a completely different approach. He was saying, let's look at the business without even looking at the stock price, And then we come up with an idea of where the stock price should be. And only then we check actually where the stock price is. And that's very powerful because it clears you from all the bias of having price influencing your view and so forth. He also was a very keen, if you want, value investor extremist in a way that he came up with this net term concept, which is basically when a stock is priced below what is the balance sheet value. So you take the whole assets of a balance sheet in a company, you take out you discount the assets for what can go wrong, the replacement value of the assets, so what's the market value of those assets, then you take out the liability, and then what is left, you see if the market price is even below what is left. And he used to invest in dozens of these companies without studying them a lot, just stopping there. And that proved to be a very good strategy. He had a great return for his year. Nowadays, there are less, the net are less frequent in the market. There are a few. We have a couple in our portfolio. But of course, when you have a company that is a net, is usually a company that has also some risks of insolvency, some problems. So it's a different story.
So could you give an example of maybe like the value investing versus a example of growth investing for the listeners?
You know, value investing, to make an analogy, is when your favorite pair of socks go on sale at 50% the usual price. You know them, you like them, you've been buying them repeatedly, and then, they're just cheaper. So that's value investing in essence. Grow investing, on the other hand, is when you venture and you go and try the new fancy fusion sushi restaurant in your neighborhood that just came up. I mean, you have great expectations, but you don't know really what it is until you try it, right? So coming from a example to a more like concrete example, is a value investing type of stock is you can say Verizon or AT&T, the telecom companies. They are very typical example of value plays. Their revenues are quite stable. They are priced at price earnings, price to book multiples that are reasonably low. They have high dividend yield. So it's the typical value play if we have to come up with a concrete example. On the other hand, if you want to look at grow investment example, you can think of a stock like Amazon. And, Amazon has always been trading at very high multiples in terms of price earnings and price to book even more. And they have always been or often been trading at a level that were discounting something in the future that was about to happen so great that was improving the valuation. So I hope with these two kind of telecom, very boring business for value, and Amazon more exciting business for growth, you get a sense of what is which.
I guess like after hearing all of that, a lot of listeners would think, okay, that's awesome, but is one better than the other? And I know that's a question that comes up a lot. What's the normal response for that one?
Our fund is called Enhanced Value Fund. So you're asking the barber if you need a haircut. So I can give you that. But look, studies say that quality and value outperform growth through the cycle. Okay. So, but, to some extent, depend on how you do the analysis and how do you find qualities today or at the time of the investment and so forth. So I don't feel like being so clear cut and black and white. What I think it's worth knowing and thinking about is that it is well known that the biggest enemy in investing is yourself, is your emotions. Okay. So if you have this in mind, all the biggest mistakes were made by, selling at the bottom or bought in the, top of the market. So the emotion play a big role, and you don't need really to be super smart to do quite well in the investment, but you need to be very rational. Now, the value portfolio tends to have a beta to the market that is lower than the growth one. So to go back to the example that we had before, Amazon, during the dot-com bubble, I was starting investing at the time, I remember that very vividly, went down 93% from peak to the bottom, right? And we're talking about one of the most successful companies in the world, was successful before and was successful after that, right? Would you have held? I'm not sure. I'm not sure I would have held to that dramatic destruction, temporary, but still mark-to-market destruction of wealth. So a value portfolio tends to have less volatility, which helps not testing your limits in terms of what you can take in terms of drawdown. So especially for the, not super aggressive and experienced investors, that's another way to say to go for value versus growth.
Right. So essentially, like most other investments, you need to look at, what's your risk profile? How risk averse are you? What style is matching maybe your investment goals or other factors within the market? Because, as you said, there's different times where different strategies have worked, and that doesn't necessarily mean they'll always work. So that leads me kind of into the next question, which is one more risky than the other? Is one riskier than the other?
Yeah, I mean, look, when anyone, whichever strategy you have, if you're a portfolio manager or if you are even an investor, what you care about in the end is the return you have on the money that you're investing and managing, right? So you don't care if it is a value defined stock or if it is a growth stock. What you want is at the end of your horizon, as you said, your time investment period, to have the best return. And as you said, you also need to look at the downside of your investment. So we discussed before, value is less volatile, the beta is lower, so you have less swings. But in terms of opportunity cost, after 10 years having been invested in some value assets, are you better off than growth? And then come down to the risks of the two portfolios. The value portfolio typically has the risk of being the so-called value trap, okay? So if we take about the example of Verizon and AT&T, they're gonna have declining revenues of single digit for the next 20 years. They are gonna have the dividend being cut, the cash flow slowing down, and then in 20 years' time, they might have been doing a bit of buybacks, but eventually you will be with a below market return. So that's the, I think, biggest risk when you look at value. You see things that are very cheap, but they are cheap for a reason, and they can get cheaper as time passes. So that's the number one issue that we have. While for growth, the problem is the opposite in a way. When you buy a growth company with a relatively high multiple, you are, like it or not, having an expectation that the future development of the company are going to be rosier and they're going to increase. So, the example Amazon, I think it's interesting because in 2006, Amazon was trading at very high multiples, even higher than today. Their core business, that was the e-commerce, were losing money and was forecasted to lose money for forever at the time. And they come up. So the investor at the time, I don't know what was thinking, but what happened in 2006 is that they launched Amazon Web Services that currently make the bulk of their cash flow and profitability. So I generally believe that in 2006, no one knew what was Amazon Web Services in the investor base of Amazon. Maybe Jeff Bezos was really betting on that, but very few other people knew that. If that were not to happen, as successfully if the competition from Google and Azure or Microsoft was harsher and quicker to catch up. We would be in a very different place today, right? So it's a great company. We love Amazon, but in 2006, you couldn't really put on a piece of paper like the prediction of what happened with Amazon Web Services. So you have to appreciate it's really unpredictable.
Yeah, absolutely. I mean, thinking about it, like you said, from the growth perspective of you're starting out as this company that goes to the moon and then drops back down to earth, unless you really understand the landscape of the market or the potential for the market at the time, which was kind of uncertain because for .com, a lot of things kind of felt like a fad or a trend. Who would have known?
Yeah, and you have also to, when you play that game, the air is very thin, and you buy Amazon as 70 times earning and can go to 100 times earnings. And the question is, I've been in that situation multiple times. When do you sell? Do you sell at all? There are the Amazon evangelists that say, I hold Amazon forever, I'm never going to sell shares because of the great history that they have. But we know past history is not, a certainty of future performance. So the question is, do you sell at 100 times earning? Currently, NVIDIA is trading at very high multiples. I can't believe that the rest of the semiconductor world is going to, look at those fat margins and not putting a lot of capex into trying to erode those and gain share into that. So the question is, when do you? It's much more difficult and arbitrary to say when do you sell, when do you get out, when do you double down, because of course you will never get to a single digit price earning multiples for Amazon, at least in the foreseeable future. So it's much more discretionary, and that's precisely why interest rates go up 1%, and then Amazon can swing 30%, and you don't have the same for Verizon because it's much less the consensus, the fork, the min and max analyst consensus is much more compressed.
Right. I mean, that actually takes me into my next question, which is like you're mentioning all of these different market factors and different multiples that may go into evaluations, which I know is a little complex for essentially this topic. But what should investors keep in mind when selecting one of these strategies? Because it is information overload if you do start to do the research, especially on some of these companies that have been around for a while or companies that are incredibly trendy or maybe trendy for the past several years. So you have years of data to go off of. What really should investors be keeping in mind when selecting one?
I think, the most important thing is make sure you make your own plan, your own strategy, and make sure you own it. Because as we discussed before, the biggest enemy in investing is yourself. If you do something because you're copying someone else, you're not really, when the market, crashes, your confidence might fade. Historically, we have been through period, 97%, 93% for Amazon was an extreme, but we've been through drawdowns of 50% of more for the S&P 500 multiple times in history. Even for stocks like Berkshire Hathaway, which is typically considered a safe stock, happened, I think, more than 5 times that they went down more than 50% peak to bottom. So if you don't have thought through your strategy, which plan you want to have, if you don't have digested it, you're more likely to deviate from it, which is exactly what you shouldn't be doing. So it better, if your plan is sound, you sort of digested it in when the times are calm, you're more likely to stick to it and have a successful experience when markets are rough. basically.
So you also mentioned earlier in the conversation, you were talking about learning about value investing versus growth. I think you had mentioned when you were in school at Columbia. What are some ways that listeners can maybe get exposed to some examples of this? Are there, I mean, we have IBKR campus, which, you can go to at any time. It's free. But are there other things out there, maybe like books or films or anything like that are like a quick reference of, oh yeah, that was a value investment approach, that was a growth investment approach?
There are, of course, countless resources. I like to, and actually we did a podcast with you guys on these letters, our Warren Buffett annual letters. There are like, I think more about 50 of them available on the website each year. And it's very interesting to read these letters with the benefit of hindsight, and read this letter in the years where the markets were really dramatically, turbulent. So I think that's a real case example where theory meet practice, and you see Warren Buffett's view of the world when the uncertainty is out there. That's very powerful for me. A book that many value investors recommend is The Intelligent Investor. And the book speaks about the market at large and how the irrationality can play at your advantage if you are calm and savvy and you don't get dragged into the craziness of certain periods. So these two resources, I think, for start is where I would definitely recommend to start.
Great. Well, you brought up some really good resources and some really great answers today, Stefano. Thanks for joining us.
Thank you. Thank you for having me. Have a great day.
Sure. So as always, listeners can learn more about an array of financial topics for free at IBKRcampus.com. Follow us on your favorite podcast network and feel free to leave us a rating or review. Thanks for listening.
Thanks for listening to IBKR's Sense of Security. As always, there's more content at IBKRpodcast.com. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education content such as webinars, market commentary, market-related courses, and quant-related articles at IBKRcampus.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.